IP and inflation data. Both these important macro numbers have come out last week, and the initial macro understanding is that Indian economy is indeed making a comeback. Let's discuss Indian macros with Robert Pryor Vanderspoor. He's head of India and Southeast Asia research with Credit Suisse. Robert, good morning. Thank you for joining us. Robert, even though you've slashed your GDP estimates for India, you are still of the view that for Indian economy, we could see a lot of back-ended growth. Now, why is that?
The number for the current fiscal year I did before the September quarter GDP, which I must say disappointed me. So I certainly think the risks to that 5.9% number for the current fiscal year are slightly on the low side. However, I'm happy to stick with the 2013-14 projection of 6.9%. I'm happy to be above consensus. I think there are a few reasons to be positive. In particular, the negative effects of all the interest rate hikes are now being lost, and indeed it's interesting, I think, to note that some of the market-related interest rates, things like 3-month interbank rates, 1-year commercial paper rates, have now been falling for about a year, are down more than 100 basis points from their high. That should start to kick in, should start to improve activity. Also, you've had obviously a much weaker currency, and that should help real net exports position as well going forward.
Robert, hi, morning. So what does this spell out for the monetary policy? Because markets were pinning their hopes on a rate cut by the RBI.
Yes, I'm not holding my breath for a December 18th reduction, certainly not in terms of the repo rate. There's a chance we get a cash reserve ratio reduction once again, although I think the probability is slightly less than 50% on that. However, I am looking for a January 29th repo rate reduction, perhaps of 50 basis points. Key here, I think, is not so much the inflation data. The RBI made it clear that it was likely to cut interest rates in that January to March quarter, effectively, even if inflation remained quite high at around 7.5% or so. I think that the likely reduction will be should be seen more as a pat on the government's back, albeit a belated one, for the various reforms that the government has implemented.
So, Robert, finally, what kind of easing are you penciling down in your growth forecast? Will Reserve Bank of India, do you think they will continue to track inflation in deciding its moves?
Well, after this potential January rate reduction, I think the focus will once again be very much on inflation. And I think we will need to see headline wholesale price inflation numbers coming down quite a lot to trigger further reductions. However, I think that's exactly what will happen. I'm looking for WPI inflation to drop below 7% in the not too distant future, and actually drop below 6% by the middle of 2013. Now, against that background, and with growth recovering, but in a fairly subpar fashion, I do think we'll see further interest rate reductions, and I'm pretty aggressive still in my view. We're looking for a total of 125 basis points more in the way of repo rate cuts, probably by around July of 2013.
But Robert, just want to get you in. Some momentum has been seen on divestment front. Also, the government is now talking about another round of auctions as well. Do you think India can rein in its fiscal deficit with the targeted limit?
Well, I think even if the government meets its ambitious divestment programme, and hopefully it will, but that's clearly not guaranteed, it's going to be a struggle to achieve Chidambaram's 5.3% of GDP number for the current fiscal year. We know he's trying hard to rein in spending in particular, but I think the challenge is just too big. So I suspect we will see an overshoot, perhaps not to the sort of 6 to 6.1% numbers that certainly we had expected, I think a number have expected. I would expect the number to print with a number beginning with 5, but perhaps late 5s rather than low 5s.
Robert, what about global challenges? Do you see any risk of US falling off in case we don't see a concrete, a concrete way how fiscal cliff will move?
Yes, I think the US is certainly going to fall off that fiscal cliff. The real question is to what extent will it fall off that cliff. Now, our feeling is that we will get probably a last-minute compromise. But even so, the fiscal tightening is likely to amount to at least 1.5% of GDP in 2013. Now, of course, we've had fiscal tightening in 2012 as well, probably about 1% of GDP. So, relative to 2012, our guess is that we'll see an additional fiscal squeeze of at least 0.5% of GDP, and that in turn, is likely to cap US economic growth to a certain extent, and of course will hinder the recovery in Indian exports to a modest extent as well.